AI is moving at the speed of light, but the hardware that it runs on is still stuck in the slow lane. We're on track to hit a massive wall in AI growth unless we change how data moves entirely. Today, we're going to be taking a look at some new ETFs around photonics. Wall Street is betting that these ETFs will help with that AI bottleneck. These are all very new funds. Some have just been around for a few weeks with almost no history to reflect back on. So we're going to take it slow, look at the details, so you can decide if they're the right fit for your portfolio. Here's the problem that we're currently facing. The smartest chips in the world, like the ones powering AI, are incredibly fast, but they're using and waiting on slow wires to talk to each other. This is called the AI bottleneck. This is leading to everything backing up when there are systems still reliant on old copper wires, technology that's been around for decades, that has limitations, that's outdated. And now it can't keep up as data starts to explode. So, photonics is the proposed fix. Instead of sending data with electricity through copper, photonics sends data using light. And light is faster, it's cooler, and can carry way more information. So this is an issue that needs to be addressed, leading to all these ETFs popping up. When it comes to this area and so many others, more than 900 ETFs were launched already in 2026. Photonics is one of the fresh themes. Okay, so the first ETF we're going to take a look at is ticker symbol LYTE, the Roundhill Photonics and Optics ETF. It's currently $24.80. This fund is from Roundhill, recently put out a hugely popular fund, the fastest growing ever, DRAM. When it comes to this LYTE ETF, it started trading on August 6th of 2026. It has an expense ratio of 0.65%, and its goal is to give exposure to the compute and connectivity layers powering the AI infrastructure. When you take a look at the holdings, you might be surprised because it's most heavily into US Treasuries at about 26%. This is basically the safest, shortest term government bonds that you can buy. After that, we start to see some companies like Coherent, as well as some other Chinese optical companies. So why so heavy into government bonds? The fund wants exposure to certain photonic companies, especially those overseas ones, but they have a certain set of rules that they have to follow. So in order to make this happen, it's holding a big pile of cash in these short-term treasuries as part of how this fund is currently structured. Those treasuries are proving that they have a strong foundation. Definitely not the exciting part of the fund, but it's what's helping them be on track to deliver the photonic exposure that it promises. We're most definitely not interested in this fund because of any bonds. We want to capture the growth of the photonic and optics companies, but this is how they're able to make that happen. And when it comes to this fund, they're including many companies that the regular US funds don't hold, which might be a plus. We shall see, because there's extra factors like the currency moves and political uncertainty. So when you invest here, not every dollar is going into a photonics company, but I want to take a little bit of time to explain why and remind you to always take a look at those holdings. Next up, let's take a look at ticker symbol EUV, currently $24.21. And this is a lithography and semiconductor photonic ETF. It launched on May 6th of 2026. It has 41 holdings and an expense ratio of 0.35%. Its biggest positions are into well-known companies like Taiwan Semi, ASML, Applied Materials, and Lam Research, as well as Lumitum and Coherent, which we saw in the Roundhill Fund LYTE. So this fund is not pure photonic. It's a mix of chip making companies plus those photonic related names. So here we're getting established industry leaders as well as companies related to this light-based trend. So the share price of this fund has moved around a lot, which is normal for a brand new specialized ETF like this. No history to reflect back on to find out where this price is going to settle. Now on to ticker symbol FOTO. And this one is a pure play photonic ETF, currently $18.42 a share. This one launched on May 29th of 2026, and it has an expense ratio of 0.75%. This is a managed fund, and they're looking for companies where photonics makes up at least half of the revenue or profit. So in this fund, we're getting names like Lumitem and Coherent, but kind of similar to ticker symbol LYTE. It's most heavily weighted into cash and Treasury bill. The fund managers don't want to be 100% invested. So they hold some cash here, waiting for better prices, managing risk, and setting up the portfolio the way that they want. So it's called the Pure Play Photonic ETF, but it's not holding stocks all of the time. They're using the cash and treasuries to continue to build. So these are the main three funds that I wanted to share, but we have a couple others coming up soon that are doing something a little different. So this is on the 1 month time frame because these funds are very new, and we can see that there's been a lot of dips, which can cause investors to get scared. But you have to understand what you're invested into. Always have that clear distinction as to, is this a trade or is this an investment? And we have to remember that these are new. They're popular, which can lead to prices running up. And then investors start asking themselves, how much future growth do these funds have? So we always have to be ready for profit taking and a normal cool off. But this doesn't automatically mean that photonic idea is broken. It's an area where we have to expect volatility for these brand new specialized products. These are not broad, diversified funds. There's definitely no history to reflect back on. They're in the early stages, and the market can get ahead of the actual results. So, just a quick recap on the details of these three funds. We have LYTE, which just came out this month, August 2026. It has an expense ratio of 0.65%. Ticker symbol FOTO and EUV have been around since May of 2026. Ticker symbol FOTO has the highest expense ratio of these three funds at 0.75%, and EUV has the lowest at 0.35%. And taking a look at the performance so far, LYTE is down about 2%, EUV is down 9%, and FOTO is down about 25%. And LYTE has had a low of $23.32 and a high of $28.91. FOTO has had a low of $15.94 and a high of $27.86. And EUV has had a low of $20.61 and a high of $31.99. Here's a quick look at two other funds in this area. These two came out in June and July of 2026. We ticker symbol LAZR and ticker symbol LUMA, which I didn't even see any detail when it comes to these two yet. But ticker symbol LAZR is a photonics and optical ETF with an expense ratio of 0.75%. It owns photonic and optical companies and also has exposure to the private AI company Anthropic through a special vehicle. So this one has that private AI piece. And then we have ticker symbol LUMA. And this one is described as more of a global mix of photonic and optical names. The assets when it comes to this fund are at about 7 million, much lower than the first three funds that we looked at that were between 138 and 456 million. So there's even more risk when it comes to a fund like this. It'll be harder to trade and more sensitive. But I just wanted to mention them in case you want to put them on your watch list. There are lots of different ways to getting exposure to different areas, different themes when it comes to choosing ETFs for your portfolio. Ticker symbol LUMA currently has an expense ratio listed here at a full 1%. But I have read that there is currently a voluntary management fee waiver of 0.35%, bringing the expense ratio down to 0.65%. But that could be modified or eliminated at any time. So, ticker symbol LUMA is currently $24.50. It's had a high of $28.14 and a low of $19.12. Ticker symbol LAZR is currently $43.66. and it's had a historical low in the couple of months that it's been around of $32.55 and a high of $50.82. So I do not hold any of these ETFs in my portfolio yet. Looking at the price movements, if I do start a position, I'll be looking to focus on limit orders, catching the lowest prices possible, seeing the movement that they've had in just their short time span that they've been on the market. And these would be smaller allocations when it comes to my portfolio to complement other investments that I have. They have very high expense ratios. These are managed fees that in time could justify by the performance that they bring to your portfolio. But I have to manage my risk tolerance in incorporating new funds with this level of volatility. I'm in a place where I like simplicity. I like quality when it comes to my portfolio, and I can reflect back on 10 or 15 year investments that I'm currently holding. And I won't have that here. Before you put any money into any of these funds, ask yourself a few questions. Do you understand the structure of the ETF? Am I okay with these higher expense ratios? Can I stand the price swings? These are not broad market funds. They're specialized and going to move differently than the S&P 500. There's no track record, just a few months when it comes to the fund. Am I going to take the time to research the individual companies within help me make my decision? Does this fit my overall portfolio strategy? Can I find the names in those top holdings in a more established fund? So when it comes to AI, it really is creating more traffic, and LYTE can move the data in a more efficient way than those old copper connections. This is an area that needs to be developed. But remember, these funds are new. They're more volatile. They have a structure that may be unfamiliar to most of us holding all of these cash and treasuries. We need time to learn how they're going to behave. So when it comes to my portfolio, I'll always be making sure that I have a majority of it in something that is stable and solid before jumping on board with new funds like these. Like I said, most likely you are getting some level of exposure if you are in more established tech or semiconductor funds, or even the S&P 500 or total US stock market, but it's not going to be as concentrated as incorporating one of these funds into your portfolio. There's no one size fit all portfolio, in my opinion. You have to put in the work to make sure you're creating what you can stick with long term. Be a thoughtful investor, put the work in, and make sure that you're on track to make your money make more money. Thanks for watching. Okay, bye.